So what if I told you the big banks and hedge funds can actually control the markets, and that with a little observation, you could easily spot their moves before anyone else? Volume price analysis is the answer. The volume price analysis is based on the idea that big players like banks and hedge funds manipulate the market behind the scenes. Once you accept that, you can assume that these big players know where the market is going before anyone else. If that's true, then all you need to do is follow their moves. You want to buy what they're buying and sell what they're selling. And when they're not actively participating, you should stay out of the market too. So these are the simple concepts behind this trading method, and we can see what the big players are doing by paying attention to price and volume. Basically, even though these big players try to hide their moves, there's one thing they can't hide: the volume. Since they handle such huge amounts of money, it's obvious when they're getting in or out of the market because the volume will increase. On the other hand, if the price rises but the volume stays low, that usually means the big traders are just manipulating the market but not actually putting in any real money themselves. So you have to be careful of traps in those cases. Only by keeping an eye on both price and volume together, you can read what those banks and hedge funds are up to. And once you know where they're putting their money to work, you've got a good idea of where the market is likely headed next. This volume price analysis method was developed by Richard Wyckoff back in the day. He came up with 3 main laws that is based on. First law is about effort and result. Basically, it means the volume or the effort needs to match up with the price move or the result. So if the volume is high, you should see a big change in price. If they don't line up, something ain't right. You can use anomalies between volume and price to figure out if the big players are buying or selling. We'll talk about them later in the video. Wyckoff's second law is about cause and effect, basically about time. If they take a long time to build up a new move, you can expect the resulting price change to be large too when it happens. The final law is supply and demand. If supply is greater than demand, price will drop. But if demand is bigger than supply, then price goes up. These 3 laws explain how price is always rotating between bull and bear markets over different time periods. And volume helps uncover what the big money are doing. This trading cycle follows the same pattern no matter what time frame you look at, whether it's a 1-minute chart or 1-month chart. Of course, you have the odds in your favor when you're analyzing higher time frames. I prefer to monitor the daily chart when I'm analyzing volume. It's easier this way. 1 candle means 1 trading day, and it has more meaning than the 1-minute time frame. A full rotation between market phases happens from the selling climax down to the buying climax and back up again. When I talk about a buying climax, that's when big players are starting selling near the top of a rally. The selling climax is when they start buying at the bottom of a drop. At the buying climax, the market has been moving up so long that little guys are terrified of missing out. Eventually they cave and jump in right as the big players start their selling into a weakening market. Volatile price action and news are used to dump their positions. FOMO, or fear of missing out, is a powerful emotion the big traders use to their full advantage, getting the little retail guys to buy at high prices. Once their positions are cleared, they start planning the next phase. The selling climax happens when the big money players need to refill their positions. At this point, fear of losing money triggers everyone else to bail their positions. Quickly, the big players crash the price down, usually because of some news. Then retail traders panic sell right into the big guys' buy orders. And once they have accumulated enough, the big guys jump in to stop the market from falling further. And then a next phase begins. This also explains why markets drop faster than they rise. Smart money have all the time in the world to let prices rise to make their big profits. They actually plan everything. The worst thing for them would be getting overwhelmed by too much buying or selling early, wrecking their new plan. That's why before starting a new campaign, they run a quick test. Once the big accumulation phase finishes at the selling climax, before they launch their new campaign, they run a quick test. This makes sure any leftover sellers have been soaked up. Doing so ensures the upcoming bull run can unfold smoothly without any major sellers pulling it down. The test involves a small downward price push below support. Volume staying low confirms it. They call it a supply test. If it passes with low volume, their next buying campaign has the green light. Similarly, at the end of the big rally, the buying climax, a demand test happens before the bearish move. The big guys briefly send price higher, oftentimes above resistance, and no extra demand means it will drop back with ease, and this confirms no major buyers are around. So the whole premise of understanding the volume price analysis is accepting the big players control and manipulate everything behind the scenes. The only thing we need to know is when they're actively buying, selling, or sitting out a move. In my approach, watching each daily candle, monitoring price changes and volume helps me with that, by looking if those two factors sync up or contradict each other. If the price and volume are high, then the big players are steering things and are in the driver's seat. But if they are in disagreement, things are suspect. One of the most important areas on the price chart is when a market is in a congestion phase, as markets spend 70% to 80% of their time in such regions, and only 20% of time trending. It's real simple. These are the areas where new moves are cooked up by the big players planning for the next part of their plan. And this could be huge areas, like right before a big sell-off or a rally, or even maybe smaller moves where a market has paused in the primary trend. Understanding congestion phases, along with support and resistance or supply and demand, is a key element of volume price analysis, and many traders don't get it or ignore it trying to chase trends all the time. The longer a market remains at a price level, then the greater the concentration of volume, and price will only continue to move on once the balance of bearish or bullish sentiment shifts. And whenever a breakout happens, volume tells you if it's a real move or fake news. So, support and resistance levels, supply and demand, and price action must be part of this volume analysis. This example shows a wide range candle over one trading day. Volume was way above average, so the trading activity backed up the price movement that day. For a move to be real, the effort to push it higher should be seen in the volume. That's why Koff's third law. It takes effort to drive prices up or down. So a big daily change means heavy trading volume backing it up. And that's exactly what we got here. Therefore, volume validates the price action as genuine. So the move wasn't secretly manipulated by the big players or the market makers. And for now, the trend is still bullish since we don't see anything telling us otherwise yet. This chart shows a narrow body candle with wicks on top and bottom. Trading volume was way below average. Even though the price increased a bit, the move was really small, so the candle is narrow. The volume backing it up is also low. That's because of Wyckoff's law again. Effort and result need to match up. If the price only increased a bit, then volume, the effort, shouldn't be heavy. So once more, the volume confirms that what we're seeing with price action is real. A small daily price increase implies slim trading activity. Volume is still validating the price movement as genuinely reflecting what's happening behind the scenes. And here we see a white candle, so the volume should match that big move. Instead, volume is low even though price had a wide range, and this is a divergence. A large daily candle body usually means heavy trading to push it there, but a low volume bar doesn't add up. If I was already in a long position and saw this, I'd start questioning the move. Could it be a trap forming? You will see this divergence pattern often shows up at the start of equity sessions. Basically, the big money is filling out the sentiment in the market by shooting price up to test the buyer interest. But again, the move was fake. It's designed to trick traders into weak longs and hit their stop losses before price reverses. And that's why VSA is so powerful. Volume reveals the truth behind prices. It unmasks the intentions of big players setting traps versus real momentum shifts. Now we see a narrow candle range, but massive volume, which is another mixed signal. A small price move should need low volume, but that's not happening here. There's really only one way to read this. The market is starting to look suspect. Patterns like this often show up at turning points, like tops of price increases or bottoms of down moves. For example, in an established bullish phase, price rises a bit at the open, but then the big boys start cashing out their gains. More buyers hop in, but price stops going up since the smart money are selling into them and pocketing profits at this level. What's actually happening is this price can't keep rising no matter how many buyers jump in, because the smart money are constantly selling to take profits. So when the price and volume tell different stories like this, it's signaling underlying weakness in the overall trend. Here we see a rising market, with prices following volume higher, and that's exactly the sync we want to see. The first candle has a small range, and volume is low, matching the little price move, so no issues here. The second candle is wider, so volume should be greater. And yes, volume increased along with the price action. By the third candle's even bigger daily range, its volume needs to be really strong. Once again, trading activity backed up the result. Price action on the candles has been validated by the volume. Price increased higher over the period, while volume increased with it each step of the way. Everything is lining up between effort and result. Bullish price action reinforced by heavy buying volume. This is the ideal trend validation. In this example, we see a confirmed uptrend, starting with a small candle on a low volume as expected. The second candle's range increased a bit, but volume was higher compared to the tiny price action. That's a divergence. A small price move shouldn't pump volume that much. Candle number 3 was wider, but volume decreased versus the big move before. It should have been higher too, with a bigger daily price change. Another warning. Then candle number 4 was a wide range one, yet volume dropped again, so multiple mixed signals stacking up. A wide price swing shouldn't have volume declining more, and falling volume conflicts with the ongoing bullish run. We have several divergence problems in this supposed trend. Things are no longer lining up like they should between effort and result. I hope you see how price alone can only tell you what the market present technical position really is, but not where the trend is probably headed, at least not accurately. Volume helps to validate the trend with more accuracy, and also detects turning points and when to open or close trades. And together they form a complete picture. Price must go hand in hand with volume. Is it possible to make money trading using price action alone? Sure, but price in combination with volume is 10 times better. First you see what the candlestick is telling you, then you check the volume to see if it's validating or not the recent price action.